Hello everyone, in this video we are going to discuss the Pakistan budget for the year 2023, the facts and figures, and some significant changes made in taxation. If you like this video, please like it and subscribe to my channel. Pakistan is a rising market economy in the Asia-Pacific region, faces unique challenges compared to the experienced developed nations. The country's geopolitical situation, challenging financial environment, and high inflationary pressures have significantly affected global growth prospects. These factors also pose substantial economic risks for Pakistan. Furthermore, devastating floods and political unrest have further worsened the situation. In 2022, Pakistan's economy witnessed a high growth rate of 6.1%, however, it was unsustainable as it was largely driven by domestic demand and ended up with a high fiscal and current account deficit. From July to April in the financial year 2023, CPI inflation stood at 28.2%, significantly higher than the 11% recorded in the same period the previous year. Various factors have contributed to this inflation, including adjustments in power and gas costs, a significant rise in food prices, currency depreciation, soaring global fuel and commodity prices, and recent devastating floods. To counter inflationary pressures, the State Bank of Pakistan raised the policy rate by 725 basis points in the past year. Let's review some highlights of the budget 2023-24. The total outlay of the federal budget is Rs 14,461 billion, which is 30.4% more than the size of the budget, revised, estimates of last year. The projected interest payment is estimated at Rs 7,303 billion, which is 32.3% higher than the figures of Rs 5,520 billion in the revised budget. The current expenditure of the country is estimated at Rs 13,320 billion compared to Rs 10,528 billion a year ago. The total federal expenditure is estimated at Rs 14,461 billion, current expenditure Rs 13,320 plus development expenditure 1,140 rupees. The current expenditure accounts for 92.1% of the total estimated expenditures, which is a substantial growth. The defense budget is estimated at Rs 1,804 billion, which is almost 13.67% higher than the revised figures of Rs 1,587 billion last year. Federal government will decrease subsidies by Rs 29 billion to 1,074 billion rupees from Rs 1,103 billion in revised estimates of last year's budget. Provincial share in the NFC award is estimated at Rs 5,276 billion, which is 57.3% of the FBR's revenue collection. The size of the total PSDP is estimated at Rs 2,709 billion, which includes a federal PSDP of Rs 950 billion, a public-private partnership worth Rs 200 billion, and provincial PSDP estimated at Rs 1,559 billion in this budget. Moreover, the federal government has projected a Rs 9,200 billion worth tax revenue target in this budget, almost a 28% growth from the current fiscal year's revised figures of Rs 7,200 billion. The projected GDP growth is 3.5%, and inflation is projected at 21% during this year. Factoring in the same, the FBR's projected tax revenues growth of 28% seems achievable. However, the FBR will need to enact Rs 236 billion worth of additional tax revenue measures. However, in my view, the government may be able to collect Pkr 9,200 billion worth of target should tax measures be enforced effectively. Pakistan has an excellent potential to enhance its tax revenue collection and can easily finance its debts and deficits. Budget at a glance 2023-24. Total revenue. During July to March fiscal year 2023, total revenue grew by 18.1% to Pkr 6,938.2 billion, driven by a significant increase of 16.5% in tax collection. Non-tax revenues also rose by 25.5% to PKR 1,320.5 billion during the same period. Total expenditure. From July to March fiscal year 2023, total expenditure rose significantly to PKR 10,016.9 billion, compared to PKR 8,439.8 billion in the previous year. Markup payments experienced a remarkable increase of 69.1% during this period. Current expenditures accounted for 70.2% of the total, while development expenditures represented 29.8%. Development expenditure from July to March of fiscal year 2023 reached PKR 1,060.4 billion, compared to PKR 1,051.1 billion in the previous year. Non-markup expenditures grew by 7.7% during the same period, in contrast to a significant increase of 32.1% in the previous year. Now let's discuss the projected economic indicators for 2023 to 24 defined in the budget. The real GDP growth is 0.29%. The inflation CPI is 28.2%. The debt-to-GDP ratio is 70%. The policy rate is 21%. Now let's discuss some important changes made in taxation. The size of the annual development program is fixed at PKR 1,150 billion, which includes PSDP amounting to PKR 950 billion and net lending amounting to PKR 190 billion. IT sector recognized as SME, limit enhanced from PKR 250M to 800M. Exemption of customs duty on import of raw material for batteries, solar panels, and inverters. Duty-free IT-related imports up to 1% of export proceeds. A progressive super tax regime has been introduced in the range of 1 to 10%, previously it was capped at 4%. GST raised on Tier 1 retailers of leather and textile from 12% to 15%. Withholding tax on overseas payments made through debit/credit cards is raised to 0.5% for filers/non-filers from 1%. Minimum turnover tax reduced from 1.25 to 1% for PSX-listed firms. A 0.6% tax has been imposed on cash withdrawals by non-ATL. The Desu hydropower project has been allocated a maximum of PKR 58.59 billion. PKR 17 billion has been allocated for the Karachi Greater Water Supply Scheme. PKR 14.86 billion has been allocated for the Karachi Coastal Power Project. PKR 16 billion will be spent on the Pakistan-Tajikistan transmission line. For the rehabilitation of flood-affected areas, PKR 6 billion has been earmarked. PKR 5.70 billion has been allocated for the Hyderabad-Sucker Motorway Project and PKR 5 billion for the New Gwadar International Airport. PKR 107 billion has been allocated to the Ministry of Water Resources. The Higher Education Commission is set to get PKR 59.71 billion. Reimposition of 10% final withholding tax on issuance of bonus shares by a company. 50% tax on unexpected earnings arising from exchange gain. 50% reductions in tax liability for 3 years for youth entrepreneurship, maximum limit of PKR 2 million for individuals/AOP and PKR 5 million for a company. Imposition of additional tax at the rate not exceeding 50% on income, profit and gains of a person or class of persons on account of extraordinary gains due to exogenous factors. Increase in Benazir Income Support Program allocation from PKR 400 billion to PKR 450 billion. Salaries of government employees increased by 35% and 30% for grades 1 to 16 and grades 17 to 22 to improve their purchasing power. Upward revision in pensions and increase in minimum pension to PKR 12,000. Super tax under Section 4C is required to be discharged through quarterly advance tax. Further, 3 new slabs for levy of super tax on taxable income exceeding 350 million rupees are introduced with super tax rates from 6% to 10%. Tax incentive for 30 years is provided to the RECO-DIC project, being a qualified investment under the Foreign Investment, Promotion and Protection Act of 2022. Tax credit for the construction of the new residential house, amounting to 1 million rupees or 10% of the amount of tax assessed, whichever is lower, is introduced subject to certain conditions. Reduction in tax liability of a builder by 10% or 5 million rupees whichever is lower is introduced. The scope of the term associates under Section 85 is extended to cover persons having a sufficient influence on other persons for economic and financial dependence. Additional tax is to be levied on any income, profit, or gains, arising due to economic factors to be notified by the government for the preceding 5 years from tax year 2023 and onward. Such additional tax will also be applicable for entities covered under 4th, 5th, and 7th schedules to the ordinance. No explanation will be sought under Section 111 for inward foreign exchange remittance up to $100,000 or rupee equivalent, as compared to the current limit of 5 million rupees. Commissioner Inland Revenue is empowered to collect non-tax revenues under other laws. Automatic issuance of exemption certificate through IRIS introduced, where the Commissioner of Inland Revenue does not process the exemption application for payments to non-residents within 30 days of filing the application. Sales tax return filing requirement withdrawn for availing final tax regime for exporters of software, IT services, and IT-enabled services, certified by the Pakistan Software Export Board. The business turnover threshold for small and medium enterprises, SMEs, enhanced from 250 million rupees to 800 million. Category 3 SMEs, having turnover above 250 million rupees but not exceeding 800 million rupees introduced. Depending on the option elected by such SMEs, these SMEs will be subject to tax at 20% of taxable income under the normal tax regime and 0.75% of gross turnover under the final tax regime. International Center of Tax Excellence to be established by FBR, which intends to develop national tax policy, research in tax administration, international tax cooperation, workshop, seminars, and conferences for knowledge and upgradation of tax officials. An adjustable advance tax of 200,000 rupees introduced on the renewal of a domestic aid visa to any foreign national working in Pakistan. Advance tax on the purchase or transfer of property will not apply to the non-resident individuals holding POC, NICAP, and CNIC, acquiring property through foreign currency value account or NRV rupee value account. Tax under Section 113, minimum tax is reduced from 1.25% to 1% for companies listed on the stock exchange, excluding listed companies that are already subject to specified reduced minimum tax rates. The rate of tax to be collected under Section 148 for commercial importers of finished goods is enhanced from 5.5% to 6%. The withholding tax rate under Section 152, 2A, for payment to non-residents on the sale of goods has been increased from 4% to 5% in the case of a company and from 4.5% to 5.5% in the case of other than companies. The withholding tax rate under Section 152, 2A, for payment to non-residents on the rendering of services has been increased from 8% to 9% in the case of a company and from 10% to 11% in the case of other than companies. The withholding tax rate under Section 152, 2A, for payment to non-residents against contracts has been increased from 10% to 11% for sportspersons and from 7% to 8% in the case of others. The withholding tax rate under Section 153 for payment to residents on the sale of goods has been increased from 4% to 5% in the case of a company and from 4.5% to 5.5% in the case of other than companies. The withholding tax rate under Section 153 for payment to residents on the rendering services has been increased from 8% to 9% in the case of a company and from 10% to 11% in the case of other than companies. Tax under Section 153 for payment to residents on the rendering of specified services has been increased from 3% to 4%. No change in the withholding tax rate of 1.5% for print and electronic media. The withholding tax rate under Section 153 for payment to residents on contracts has been increased from 10% to 11% in the case of a sports person and from 7% to 8% in the case of others. The adjustable advance tax rate is increased from 1% to 5% on payments to non-residents through debit/credit or prepaid cards. Reduction in tax liability to 50% for 3 years for youth entrepreneurship is introduced with a maximum limit of 2 million rupees for individuals/AOP and 5 million rupees for a company. Youth is defined as a natural person up to the age of 30 years. A reduced rate of tax of 20% is introduced for banking companies in respect of income from advances for information technologies services and information technology-enabled services. Income of the Export-Import Bank of Pakistan, Film and Drama Finance Fund, and certain other entities are exempted from tax. Profits and gains of an SME set up as an agro-based industry in rural areas are exempted for a period of 5 years from the tax year 2024 to 2028. The time limit for the exemption on any income of any individual domiciled or company and association of persons resident in the tribal area forming part of the provinces of KPK and Balochistan is extended till June 30, 2024. Let's discuss changes made in the Sales Tax Act of 1990. The amendment brought through the Finance Act, 2022 to treat transmission and distribution of electricity as goods reverted in line with the recent consensus amongst the Federation and provinces for taxing the same as a service. Retailers of jewelry items and other retailers qualifying as Tier 1 retailers presently based on the shop's area brought out of the scope of Tier 1 retailers. Zero rating facility extended to the supply chain of the Reco-Dick project and local supplies of commodities to registered exporters under the Export Facilitation Scheme. Exemption withdrawn on various edible goods sold under a brand name including red chilies, ginger, turmeric, yogurt, butter, meat, and meat offal regardless of their packaging. The exemption provided on the import or supply of specified items, including contraceptives, bovine semen, saplings, combined harvesters, agricultural dryers, planters, and certain goods for software exporters. Expansion in the scope of existing reduced rating of 1% to medicaments falling under Chapter 30 of the Customs Act, 1969, excluding specific items, with retrospective effect from July 1, 2022. Extension in sales tax exemption to FATA/PATA till June 30, 2024. Increase in sales tax rate from 12% to 15% on finished articles of textile and leather supplied by the POS integrated retailers. Let's discuss Customs Act, 1969. Municipal limits being within the territorial jurisdiction of Pakistan, assigned to customs authorities for conducting anti-smuggling operations. Provincial levies and Qasadar force to assist customs authorities whenever requested. Extension of in-field exemption notifications issued on or after the first day of July 2016, up to June 30, 2024. The Director of Customs Intelligence consults international publications in assigning the values of goods to be imported or exported. Warehousing period for perishable items to be enhanced from 1 month to 3 months. Passengers traveling in groups can now file their baggage declarations through representatives. The penalty imposed on failure to place documents with the consignment to be withdrawn. Penalty in respect of failure to upload documents with the goods declaration is capped to the upper limit of 50,000 rupees. Lower limits for penalties have been prescribed to deter smuggling and evasion of duty/taxes. Option for online adjudication through customs computerized systems to be provided. The usage spectrum of confiscated items enhanced to any item/equipment deemed useful in anti-smuggling operations. Transfer of ongoing cases to different field formations to be allowed for achieving merit. Classification of orders passed by the Chief Collector of Customs as appellate and quasi-judicial orders, enabling appeals before the appellate tribunal to make it aligned with the Kyoto Convention. Persons qualifying as compliant taxpayers per the FBR shall be able to self-file their goods declarations. Applicability of certain notifications from the scope of advance rulings has been excluded. Exemption of CD to be provided on certain items on inputs of Holy Quran printing, solar panel manufacturing, diapers, sanitary napkins, adhesive tape, organic composite solvent and thinners, molds and dyes, mining machinery, rice mill machinery, machine tools, seeds for sowing, shrimps/prawns/juveniles for breeding and roasted peanuts for RUSF manufacturing. One additional active pharmaceutical ingredient, API, and 3 drugs are to be included in the existing duty-free regime. Customs duty was withdrawn on the import of IT-related equipment for exporters of IT and IT-enabled services to the extent of 1% of their export proceeds. Reduction of customs duties on intermediary/industrial inputs falling under specific codes. Customs duty concession provided on raw materials/inputs for capacitor manufacturers. Customs duty reduced on non-localized CKD and heavy commercial vehicles from 10% to 5%. As per salient features, ACD exemption is to be provided on raw materials for hemodialyzer fluid/powder. Exemption on import of machinery and equipment for erstwhile FATA areas extended until June 2024. Customs duty concession on import of flavoring powders for snack manufacturers to be extended till June 2024. Customs duty reduction on import of PET scrap for polyester filament yarn manufacturers. Part 5 of the 5th Schedule of the Customs Act to be streamlined with the Auto Industry Development and Export Policy, ADEP, 2021-26. Enhancement of customs duty on calcium carbides from 3% to 11% to safeguard the local industry. As per salient features, regulatory duty, RD, is to be abolished on second-hand clothing to provide relief to the destitute. Various products including second-hand clothing, fish, tiles, and sports goods. IT-related equipment. Synthetic filament yarn of polyester. Parts for flat panels, monitors, and projectors. Silicon steel sheets. Special steel round bars and rods. As per salient features, export RD is to be enhanced on molasses from 10% to 15%. RD to be enhanced on articles of glass to protect local industries. RD on tungsten filament incandescent bulbs to be levied at 20%. Introduction of new PCT codes for smartwatches and wooden splint of matches. As per salient features, capping of the fixed duties and taxes on the import of old and used vehicles of Asian makes above 1300 cc, to be withdrawn. Let's discuss federal excise duty. Fed levied 2,000 rupees per fan on energy-inefficient fans and 20% ad valorem on incandescent bulbs. Fee for technical services and royalty specifically included in Schedule of Dutiable Services. Exemption from Fed on the entire supply chain of the RECO-DIC project under the Foreign Investment, Promotion and Protection, Act, 2022. Let's discuss Islamabad Capital Territory, Tax on Services, Ordinance, 2001. Freelance exporters of IT and IT-enabled services exempt from registration requirements, subject to their annual turnover capped at 8 million rupees. Zero rating facility for taxable services provided for RECO-DIC project. Services of restaurants, cafes, and similar food outlets are subjected to a 5% sales tax rate when payments are made through debit/credit cards, mobile wallets, or QR scanning. Introduction of 15% service sales tax on electric power transmission services. IT services and IT-enabled services again made chargeable to sales tax at a reduced rate of 5% with no input admissibility. The rate of sales tax on services of IT-based system development consultants reduced from 16% to 15%. Let's have a detailed discussion on changes made in the Income Tax Ordinance, 2001. Bonus shares are to be treated as income and will be subject to advanced tax sections 2, 29, and 39 and 236C. The bill proposes to include bonus shares issued by a company in the definition of income under Section 2, 29, of the ordinance. The treatment of bonus shares as an income in the hands of shareholders has remained a disputed matter since the time of repealed Income Tax Ordinance, 1979, the repealed ordinance, as previously, under the repealed ordinance, for a very brief period, bonus shares received by a shareholder of a company were treated as income, and it was through Finance Ordinance 2002 that these were specifically excluded from the definition of income. However, subsequently, through the amendments brought via Finance Act 2014, bonus shares issued by the companies listed on the stock exchange and unlisted companies were included in the definition of income, and tax at the rate of 5% was levied on such income which was required to be collected by the company issuing bonus shares. This levy of tax on bonus shares was also challenged before the courts in Pakistan on the contention that the same is not like income in the hands of shareholders. The matter was, however, decided against the shareholders. Being a disputed matter, changes were again made in the definition of income, and the Finance Act of 2018 excluded bonus shares from the ambit of income of a shareholder. The bill now proposes to include bonus shares once again in the definition of income. Moreover, the bill also proposes a corresponding amendment in Section 39 of the ordinance, treating the income arising to the shareholder of a company from the issuance of bonus shares as taxable under the head Income from Other Sources. The bill also proposes to insert a new Section 236Z in the ordinance which requires every company, issuing bonus shares, to withhold 10% of the bonus shares to be issued. Bonus shares withheld shall only be issued to the shareholder if the company collects from the shareholder a tax equal to 10% of the value of the bonus shares issued to the shareholder including bonus shares withheld, determined based on day-end price on the first day of book closure in the case of listed company and the value as prescribed in the case of other companies. Tax on bonus shares shall be deposited by the company issuing bonus shares within 15 days of the closure of books. A company liable to deposit tax under this section shall be entitled to collect and recover the tax deposited from the shareholder, before the issuance of bonus shares. Under the newly proposed Section 236Z, the company depositing tax on behalf of the shareholder has been given the option to proceed with the disposal of bonus shares to the extent it has paid tax on behalf of the shareholder, where the shareholder neither makes payment of tax to the company nor collects the bonus shares, within 15 days of the date of issuance of bonus shares. Issuance of bonus shares shall be deemed to be the income of the shareholder and the tax collected by a company under this section or proceeds of the bonus shares disposed of and paid under this section shall be treated have been paid on behalf of the shareholder. Tax paid under this section would be treated as a final tax on the income of the shareholder of the company arising from issuing bonus shares. Permanent Establishment Section 2, 41. Fixed Place of Business. A permanent establishment, PE, is an international tax concept, which means a non-resident entity could be subject to tax in foreign countries where they conduct business. There are a few common types of PEs, including fixed places of business. The criteria for a PE are the following. A place of business has been established in a foreign country. The place of business is fixed or permanent. The business is wholly or partly operated through that fixed establishment. A fixed place of business is the most common type of PE. This means having a physical business presence in a foreign country. In line with the OECD Model Convention, the term PE is defined under the ordinance to mean a fixed place of business through which the business of a person is wholly or partly carried on. The bill now proposes to omit the word fixed from the definition of PE. The proposed change appears to broaden the scope of the definition, recognizing the digitalization of the global economy, which makes it easier for a foreign business to sell goods or services into a jurisdiction without a physical presence. As a consequence of the omission of the word fixed, foreign businesses could be considered as having a permanent establishment in Pakistan even without having a physical presence, where they are considered to have a place of business, not necessarily physical, through which they are carrying on business wholly or partly. However, it is pertinent to note that the concept of PE in international tax treaties remains largely tied to concepts of physical presence or a fixed place of business. Accordingly, relying on Section 107 of the Ordinance, the definition of the term PE as provided under the Double Tax Treaty, as agreed between any contracting state, country, with Pakistan, shall prevail over the amended definition of the Ordinance. Furnishing of services through an entity. Employer of record arrangements enable companies to outsource employment responsibilities such as payroll, benefits, and compliance to a third-party organization while maintaining control over their workforce. The employer of record acts as the legal employer of the workers, but day-to-day work is managed by the contracting company. Such arrangements are usually adopted by foreign companies to avoid the risk of the creation of a permanent establishment in another country. In the recent past, there have been conflicting decisions of the overseas courts concerning the treatment of such arrangements to be considered as having a PE in another country. The Finance Bill now proposes to amend the definition, which seeks to treat the furnishing of services, including consultancy services, by any person through another entity engaged by the person for such purpose as creating a PE of the non-resident person in Pakistan. By this amendment, any such arrangement where an entity is furnishing services on behalf of the non-resident person, including acting as employer of record, will be considered as creating a PE of the non-resident person in Pakistan. Small and Medium Enterprise Section 2, 59A. Under the existing law, small and medium enterprise, SMEs, means a person who is engaged in manufacturing as defined in Clause 4 of Section 153(7) of the Ordinance and whose business turnover does not exceed 250 million rupees. The bill enhances the turnover limit from 250 million rupees to 800 million rupees. The proposed amendment intends to align the definition under the Ordinance with the definition of medium enterprise given by the State Bank of Pakistan. Further, Bill now proposes to cover persons providing or rendering IT services or IT-enabled services as defined in clauses 30AD and 30AE of Section 2 under the definition of SMEs, thereby extending tax incentives available to SMEs to the IT sector. Discharge of super tax through advanced tax Section 4C, 5A, and 147, 4, 4AA, 4B. The current provisions of Section 147, requiring payment of quarterly advance tax, do not cover the amount of super tax levied under Section 4C of the Ordinance. The bill proposes to amend Section 147 of the Ordinance, which seeks to treat the provisions of Section 147 of the Ordinance related to discharge of advance tax as applicable on super tax payable under Section 4C of the Ordinance. How Section 147 is proposed to be amended. It seems that the legislature is of the view that super tax payable under Section 4C was always covered under the quarterly advance tax payment mechanism as envisaged under Section 147 of the Ordinance. However, such interpretation may be challenged by the taxpayers when confronted by the tax authorities in respect of the tax year 2022. Exemption under Foreign Investment, Promotion and Protection, Act, 2022, XXXV of 2022, Section 44A. Federal Government promulgated Foreign Investment, Promotion and Protection, Act, 2022, the Act, on December 13, 2022, providing incentives and tax reliefs for qualified investment as notified through the first schedule to the Act. Currently, qualified investment under the Act covers the Reko Dik project in the province of Balochistan, which includes all work done by Reko Diq Mining Company, Private, Limited and its associated companies since its date of incorporation, as well as Reko Diq Phase 1, Reko Diq Phase 2 and all subsequent phases. The Act also required to propose amendments in tax laws for providing tax incentives. To incentivize foreign investment, as envisaged under the above-mentioned Act, the bill proposes exemption of taxes on income, including capital gains, withholding taxes, and minimum and final taxes under the ordinance to the extent provided in the second and third schedule to the Act in respect of qualified investment. All investors and shareholders of the qualified investment, their associates, and companies specified in the second and third schedule including third-party lenders on account of any loan shall also be exempt from taxes and other provisions of the ordinance to the extent provided in the second and third schedule to the said Act. It is proposed that the provisions of the ordinance relating to anti-avoidance to the extent specified in the said Act including sections 106, 106A, 108, 109, and 109A of the ordinance shall not apply to the persons making qualified investments as explained above. The bill further proposes that the rates of depreciation, initial allowance, and pre-commencement expenditure under sections 22, 23, and 25 of the ordinance as applicable on March 20, 2022, shall continue to be applicable for 30 years as provided in the third schedule to the said Act in respect of persons qualifying for the exemption under this section. The exemption proposed is targeted towards Reko Diq Mining Company, Private, Limited, a company having 50% ownership of a foreign company, and applicable retrospectively from the date of its incorporation. This project is expected to create a large number of jobs in Baluchistan in the coming years. Tax credit in construction of new houses Section 65I. To incentivize the construction activities in the country, which is considered the single largest source of creating jobs, the bill proposes to introduce a new section, whereby an individual taxpayer would be able to claim a tax credit, against his tax liability, equal to lower of 10% of the tax assessed for the tax year or 1 million rupees in respect of construction of a new house. The tax credit is subject to the condition that construction is completed during the said tax year and completion certificate is furnished at the time of filing of return of income. A new house means a residential house, a layout plan of which is approved by the concerned authority on or after July 1, 2023. As per plain reading of the newly introduced section, it appears that tax credit cannot be claimed against those houses which are currently under construction and whose layout plan has already been approved by the concerned authority. Here questions would arise that whether taxpayers would be required to maintain relevant documentary evidence related to the construction of a new house and to what extent the same shall be accepted by the tax authority, considering the fact Pakistan is a cash-based economy where there is no trend and culture amongst individuals to maintain such documents. Obtaining the completion certificate may also create challenges considering the prevalent practices. Associate Section 85. The bill proposes to enhance the scope of the definition of associates. Sufficient influence. The bill proposes that two persons will now be treated as associated for ordinance, where one person sufficiently influences, either alone or together with an associate or associates, the other person. It is explained that two persons shall be treated as sufficiently influencing each other, where one or both persons, directly or indirectly, are economically and financially dependent on each other and, decisions are made by the directions, instructions, or wishes of each other for a common economic goal. Sufficient influence as introduced by the bill appears to be a lower threshold than control. This is a major change which, in addition to the existing criteria for persons to be treated as associates, would also cover entities who are economically and financially dependent on each other, even when there is no control through shareholding or voting rights. In this respect, sufficient influence can be exercised by parties acting as equals where they are acting by the direction, instructions and wishes of each other, and is not limited to a unidirectional analysis of control. While companies with the same boards of directors will not automatically be associated with each other, As a consequence of this amendment, however, the relationship between companies and their behavior needs to be considered to determine if otherwise, independent parties have sufficient influence over one another. There are likely to be several commonplace commercial dealings that now have the increased potential of creating an associate relationship between entities. Moreover, this amendment will have implications over thin capitalization rules, Sections 106 and 106A, Employee Share Scheme Provisions, Section 14, and certain targeted anti-avoidance rules, Section 108. Invoking these provisions in the absence of precedents is likely to result in disputes. Proper explanations and criteria are, therefore, to be introduced through detailed regulations to avoid any litigations. Jurisdiction with zero tax regime. The bill further extends the definition of associate by proposing that two persons shall be treated as associated where one person enters into a transaction, directly or indirectly, with the other who is a resident of jurisdiction with zero taxation regime. It is clarified that jurisdiction with zero taxation regime means jurisdiction as may be prescribed. This amendment appears to be in the context of transfer pricing between associates, consequently requiring the dealings to be at arm's length where transactions are being entered into with a person who is a resident of a jurisdiction having zero tax regime. Additional tax on certain income, profits, and gains. Section 99D. The bill proposes to insert a new Section 99D, additional tax on certain income, profits or gains, by which, for any of the preceding 5 tax years from the tax year 2023 and onwards, in addition to any tax charged, paid, or payable under any of the provisions of the ordinance, an additional tax shall be imposed on every person who has any income, profit or gains that have arisen to any person or class of persons due to any economic factor or factors that resulted in unexpected income, profits or gains whether or not disclosed in the financial statements. Federal government through a notification in the Official Gazette may notify the following. Determine the economic factor which would lead to unexpected gain or profits but not limited to international price fluctuation having bearing on any commodity price in Pakistan or any sector of the economy or difference in income, profit, or gains on account of foreign currency fluctuation. Provide the rate not exceeding 50% of such income, profits, or gains. Clarification is required. Scope, time, and payment of tax payable. Exempt any person/income or classes of person/income from additional tax. The proposed section, besides enabling the government to levy such tax, does not provide any specific details as to the levy of such tax. Further, the time limit of the preceding 5 tax years is also ambiguous and should be clarified when a notification is issued for the matters discussed above. If the intention is to levy such additional tax retrospectively, then the law should provide for that. This section is an enabling provision providing the legislature the power to levy and collect additional taxes from such sectors of the economy which have benefited in the form of income in the past few years or may benefit in the future due to any economic factor. It is a known fact that certain sectors have benefited disproportionately in the recent past due to high volatility in the currency market which resulted in a loss to other sectors in the economy triggering record inflation which resulted in high interest rates by the central bank. Unexplained income or assets. Section 111. Currently, tax authorities cannot raise queries under Section 111 as to the source of income from a person in respect of an amount of foreign exchange remitted from outside Pakistan through normal banking channels not exceeding 5 million rupees in a tax year that is encashed into rupees by a scheduled bank and a certificate from such bank is produced. The bill proposes to enhance the limit from 5 million rupees to $100,000. Before Finance Act 2019, the limit was 10 million rupees, and before that, there was no limit on account of foreign exchange remitted from outside Pakistan. Considering the abysmal state of US dollars reserves available with the central bank, this amendment is introduced to encourage the inflow of foreign currency into Pakistan. However, This policy may once again promote money laundering and the inflow of untaxed money from unknown sources. This may also create problems for the government in terms of compliance with the FATF framework. Explanation on Adjustment of Minimum Tax Section 113, 2c. The bill proposes to insert an explanation, clarifying that the unadjusted minimum tax paid shall be carried forward to subsequent tax years and shall only be adjusted against the normal tax liability payable under Division 1 or Division 2 of Part 1. Providing tax rates for individuals, AOPs, and companies, of the first schedule to the ordinance. The above explanation seeks to remove the ambiguity and practice followed by the taxpayers, whereby the unadjusted minimum tax of prior tax years was adjusted against minimum tax liability under Section 113 of future tax years. Recovery of liability outstanding under other laws Section 146d. The bill proposes to insert a new section to initiate a recovery by the Commissioner of Inland Revenue from any defaulter in respect of outstanding liability payable under any other statute or law for the time being in force. A. Treated as income tax arrears in that law. B. Required to be recovered or collected by Commissioner, Inland Revenue, or C. Is referred to Commissioner, Inland Revenue, for the recovery. The Commissioner, Inland Revenue, shall recover the said liability and deposit the receipts in the designated account specified in that law. These provisions are introduced for enabling the Commissioner of Inland Revenue to recover outstanding non-tax revenue under any other statute or law. Payment to non-resident Section 152, 5a. Current provisions require the Commissioner to issue the exemption certificate/order within 30 days of the filing of the application by the person who intends to make payment to a non-resident person without payment of tax. The said period of 30 days is not mandatory. The bill now proposes to insert two new provisos under Section 152, 5a, which further explains the procedure of applying for an exemption certificate while making payments to non-residents. The proposed amendment introduces a mechanism for the automatic processing and issuance of exemption certificates by IRS, where no action is taken by the concerned Commissioner after the lapse of 30 days of the filing of the application by the taxpayer. It is also proposed that the Commissioner may modify or cancel such certificate of exemption as issued by IRS based on reasons to be recorded in writing after providing an opportunity for a hearing. This automatic issuance of a certificate by IRS is a step forward for the digitization of standard procedures to facilitate the taxpayers for the very purpose of payments to non-resident persons without deduction of taxes. This would be also a source of big relief to the payers and the non-residents, as currently in the majority of the cases the commissioners take months to either accept or reject the application. Export Section 154, 3b. The bill proposes to include exporters duly covered under Export Facilitation Scheme, 2021 under Section 154A for tax deduction at source whilst making payment to an indirect exporter. FBR issued the SRO 957-1/2021 on July 9, 2021 to announce the Export Facilitation Scheme, 2021, EFS 2021, for exporters, manufacturers exporters, common export houses, commercial exporters, and international toll manufacturers, along with a pronouncement that all existing old schemes shall be phased out in next 2 years since then. The proposed amendment seems to cover such categories of exporters as defined under the EFS 2021 in addition to those categories covered under Duty and Tax Remission for Exports Rules, 2001 for tax deduction at source against payments to indirect exporters. Export of Services Section 154A, 2c. Currently, to avail final tax regime on account of tax deduction under Section 154A, every exporter involved in exports of computer software or IT services or IT-enabled services, where the exporter is registered with and duly certified by the Pakistan Software Export Board, PSEB, is required to file the sales tax returns with the federal and provincial tax authorities respectively. The bill seeks to insert a new proviso in subclause C of subsection 2 of section 154A, which proposes to waive off the condition of filing sales tax returns for the exporters of computer software or IT services or IT-enabled services. The tax deducted under section 154A(1) is proposed to remain the final tax even though such exporters have not filed their sales tax returns with respective authorities. Payment of tax collected or deducted by swaps agents. Section 164A. Section 164A provides synchronized withholding administration and payment system, swaps, of tax collected or deducted for payment through digital mode. Under this system, the board will notify withholding agents to act as swaps agents and make payment of tax collected or deducted through digital mode and issue swaps payment receipt, SPR, against the tax deposited by them, within the time and manner as notified. However, this system is not notified through any SRO, notification, rules, etc. to date. The bill proposes to change the title of the Section 164A. Earlier this section was titled, Payment of Tax Collected or Deducted by Swaps Agents. The bills have proposed to change its title to, Settlement of Transactions Liable to Withholding Tax by Swaps Agents. There is a likelihood that FBR may notify this system soon to take a step forward toward digitization. International Center of Tax Excellence Section 230J. The bill proposes to insert a new Section 230J to establish an institute which would be known as the International Center of Tax Excellence. With this proposition, FBR intends to develop the following functions at the national and international levels, which are as follows. Development of tax policy. Preparation of model national tax policy. Delivering interdisciplinary research in tax administration and policy. International tax cooperation. Revenue forecasting. Conducting international seminars, workshops, and conferences on the current issues faced by tax authorities in the field of international taxation. Capacity building of inland revenue officers. Tax analysis. Improve the design and delivery of tax administration for maximizing revenue and any other functions as directed by the board or the federal government. The proposed institute would be a composition of nominating committee and executive committee. Nominating committee would be comprised of the federal minister in charge, the Secretary of Revenue Division, and the Secretary of Finance, whereas, the executive committee includes Chairman FBR, Member, IR Policy, Member, IR Operations, and 2 independent members appointed by the federal government. The procedures of recruitment, remuneration, and other procedures may be prescribed through rules for special purposes, and this information will be kept confidential under Section 216(7). Advance tax on cash withdrawals. Section 231AB. The bill proposes to introduce new Section 231AB for the collection of adjustable advance tax by every banking company at the rate of 0.6% on the total amount of cash withdrawals exceeding 50,000 rupees in a single day by a person not appearing on the active taxpayers list (ATL), issued from time to time by the board. This proposed amendment is the restoration of earlier omitted Section 231A of the ordinance, which was aimed to assist the government to broaden the tax base and documentation of the economy based on the filer and non-filer status of the countryman. Previously, such provisions did not provide the expected outcome, and as per some reports it promoted a cash economy. It also appears that the person whose income is exempt from tax or not liable to tax would also become subject to this sort of advance tax collection on cash withdrawals, because the proposed amendment does not exclude such cases. Advance tax on foreign domestic workers. Section 231C. The bill proposes to insert a new Section 231C to collect an adjustable advance tax of 200,000 rupees from the agency, sponsor, or from a person engaging services of a foreign national in Pakistan. This proposed advance tax is required to be collected at the time of renewal of a domestic aid visa to any foreign national working in Pakistan. The responsibility for collection and deduction of this advanced tax lies with the authority issuing or renewing the visa. The proposed tax under this Section 231C would be collected from the agency, sponsor, or from any person who engages in the services of a foreign national in Pakistan and is adjustable from the liability of that person for the relevant tax year. Advance tax on the purchase or transfer of immovable property. Section 236K. Section 236K provides collection advance tax deduction on account of the purchase or transfer of immovable property in Pakistan. Currently, a proviso to subsection 2 of Section 236K treats the advance tax deducted as final withholding tax for the non-resident individual holding a Pakistan Origin Card, POC, or National ID Card for Overseas Pakistanis, NICAP, or Computerized National ID Card, CNIC, who has acquired the said immovable property through a foreign currency value account, FCVA, or NRP rupee value account, NRVA, maintained with authorized banks in Pakistan under the foreign exchange regulations issued by the State Bank of Pakistan. The bill now proposes to exclude such non-residents from withholding tax on the purchase or transfer of immovable property in Pakistan, and accordingly above referred proviso as to treating tax withholding as final tax for such persons is also proposed to be omitted. The first schedule rates of tax Part 1 Division IIB. The proposed amendment seeks to increase super tax rates for the income earned by high-earning persons, exceeding 350 million rupees as per the following table for tax year 2023 and onwards. Division 9 Tax under Section 113. The bill proposes to reduce the rate of turnover tax from 1.25% to 1% for a company listed on Pakistan Stock Exchange other than the companies or sectors specified under serial number 1 to 3 as follows. Rates of Advance Tax Division 2 of Part 2 of First Schedule. The proposed amendment seeks to enhance the rate of advance tax to be collected under Section 148 of the Ordinance from 5.5% to 6% for commercial importers importing goods classified in Part 3 of the 12th Schedule. Payments to Non-Residents Division 2 of Part 3 of First Schedule. The bill proposes to increase the withholding tax rate on payments to a permanent establishment in Pakistan of a non-resident person as follows. Payment for goods, services, and execution of contracts to resident persons Division 3 of Part 3 of First Schedule. The bill proposes to increase the withholding tax rate on payments for goods, services, and execution of contracts to resident persons as follows. Note: no change has been proposed in the withholding tax rate in respect of payments to electronic and print media for advertising services, which is currently 1.5% of the gross amount payable. Export of Services Division IVA of Part 3 of First Schedule. Currently, exports proceed of the IT sector are subject to tax deduction at 0.25% without stating any time limit. The bill proposes to fix the withholding tax rate of 0.25% for tax years 2024 to 2026 applicable on export proceeds of computer software or IT services or IT-enabled services by persons registered with Pakistan Software Export Board. Advance tax on persons remitting amounts abroad through credit, debit, or prepaid cards. Division XXVII of Part 4 of the First Schedule. The bill proposes to increase the advance withholding tax from 1% to 5% on amounts remitted abroad through credit, debit, or prepaid cards. The Second Schedule Part 1. Insertion of new entities in Clause 66. The bill proposes to exempt income earned by the following entities. Extension in exemption period for REIT Clause 99A. The bill proposes to extend the exemption on profits and gains accruing to a person on the sale of immovable property or shares of special purpose vehicle to any type of REIT scheme from June 30, 2023, to June 30, 2024. Extension in the exemption for residents of tribal areas Clause 145A. The bill proposes to extend the time limit for the exemption on any income which was not chargeable to tax before the commencement of the Constitution, 25th Amendment, Act, 2018 of any individual domiciled or company and association of persons resident in the tribal area forming part of the provinces of Khyber Pakhtunkhwa and Baluchistan under paragraph D of Article 246 of the Constitution with effect from the first day of June 2018. Presently, this exemption is up to June 30, 2023, which is proposed to be extended up to June 30, 2024. Exemption to entities working on ERRA contracts Clause 150. Presently, the income of Siakulam Engineering Construction Industry and Trade Company Limited derived from a contract dated May 23, 2017, with Earthquake Reconstruction and Rehabilitation Authority, financed by the Saudi Fund for Development is exempt with effect from the tax year 2017. The bill proposes to extend this exemption to Alteraz Engineering Consultant. Insertion of new clause for promotion of agro-based industry in rural areas, Clause 154. The bill proposes to exempt profits and gains of a small and medium enterprise set up exclusively as an agro-based industry in a rural area duly notified for a period of 5 tax years commencing from the tax year 2024 and up to the tax year 2028. The exemption is applicable if such enterprise is set up on or after July 1, 2023, and is not formed by the transfer or reconstruction or splitting up of an existing business. This targeted exemption is introduced to encourage the creation of employment and business opportunities in such rural areas. Part 3. Reduction in income tax payable for builders Clause 21. To incentivize new construction projects, tax relief is proposed to be given to builders registered with the Directorate General of Designated Non-Financial Business and Professions. The bill proposes that the tax payable for the tax years 2024 till 2026 on profits and gains derived from business chargeable to tax under the head Income from Business by a builder for new building construction projects excluding land development projects, whose layout plans are approved by the authority concerned on or after the first day of July 2023, shall be reduced by the lower of 10% or 5 million rupees. However, the reduced amount of tax calculated above shall not be reduced below zero. To avail of such a reduction, the builder will be required to furnish the completion certificate issued by the concerned regulatory authority along with a return of income. Part 4 Clause 11a. The bill seeks to include the Prime Minister's Relief Fund for flood, earthquake and other calamities in the list of entities that are not subject to minimum tax under Section 113, with effect from the 5th of August, 2022. Clause 121 and 122. Through the SRO 1590, I/2022 dated August 23, 2022, new clauses 121 and 122 were inserted, wherein an exemption from the applicability of tax withholding under sections 151 and 236 respectively, was provided to the Prime Minister's Flood Relief Fund, 2022 with effect from August 5, 2022. Through the proposed bill the above clauses are proposed to be amended to provide exclusion to the fund, whose name was changed from Prime Minister's Flood Relief Fund 2022 to Prime Minister's Relief Fund for Flood, Earthquake and Other Calamities. The Fourth Schedule. Application of Section 99D on Insurance Companies Clause 6db. The bill proposes that the proposed Section 99D of the ordinance, introduced for levying additional tax on certain income, profits, and gains, shall also apply to insurance businesses falling under the ambit of the Fourth Schedule of Ordinance. The Fifth Schedule. Application of Section 99D on companies engaged in exploration and production of petroleum Clause 4AC. The bill proposes that the proposed Section 99D of the ordinance, introduced for levying additional tax on certain income, profits, and gains, shall also apply to entities involved in the exploration and production of petroleum falling under the ambit of the 5th Schedule of Ordnance. The 7th Schedule. Streamlining of technical mistakes for Super Tax Regime Rule 7CA. Through the SRO 1590, I/2022 dated August 23, 2022, new clauses, 121, and 122, were inserted, wherein an exemption from the applicability of tax withholding under sections 151 and 236 respectively, was provided to the Prime Minister's Flood Relief Fund, 2022 with effect from August 5, 2022. Through the proposed bill the above clauses are proposed to be amended to provide exclusion to the fund, whose name was changed from Prime Minister's Flood Relief Fund 2022 to Prime Minister's Relief Fund for Flood, Earthquake and Other Calamities. The Finance Act, 2022 introduced Section 4C, through which super tax was imposed on high-earning persons from tax year 2022 onwards, and the same was also imposed on banking companies through the insertion of Rule 7CA in the 7th Schedule to the ordinance. However, banking companies were exempted from super tax for the tax year 2022 under the proviso to Section 4C, 1, of the ordinance, but due to a technical mistake, the Rule 7CA of the 7th Schedule to the ordinance provided that super tax was effective from tax year 2022 onwards. The bill proposes to streamline the provisions of Section 4C of the ordinance with Rule 7CA of the 7th Schedule, by amending the effective date for the applicability of super tax under Section 4C on the banking sector from the tax year 2023 and onwards. Tax on unexpected incomes, gains, and profits on banking companies Rule 7CB. The bill proposes that the proposed Section 99D of the ordinance, introduced for levying additional tax on certain income, profits, and gains, shall also apply to banking companies falling under the ambit of the 7th Schedule of the ordinance. Extension in period of relief for banking companies Rule 7D, 7E, and 7F. The Finance Supplementary, Second Amendment, Act, 2019 introduced reduced rates of tax on the following incomes arising to banking companies. Additional advances to micro, small, and medium enterprises. Additional advances for low-cost housing finance, and additional advances for farm credit. The above referred tax relief is currently available up to tax year 2023. The bill proposes to extend this relief period up to tax year 2025. Relief for banking companies on additional advances to IT and IT-enabled services Rule 7G. The bill proposes to introduce a new Rule 7G, providing for the reduced rate of tax of 20% in respect of taxable income arising in the hands of banking companies from additional advances for IT services and IT-enabled services, for the tax years 2024 to 2025, subject to the procedures and guidance as provided in the rule. It is proposed that the reduced rate shall apply to banking companies, subject to the condition of furnishing certificates from external auditors along with accounts while e-filing return of income. The said certificate should certify the amount of such advances made in the preceding tax year, the additional advance made for the tax year, and net markup earned from such additional advances for the tax year. Rule 7G, IT and IT-enabled services, shall have the same meaning as provided in Section 2 of this ordinance. Additional advances means any average advances disbursed in addition to the average amount of such advances made in such sector by the bank for the immediately preceding tax year starting from 2023. Through the proposed insertion, taxable income arising from additional advances shall be determined according to the below formula. Taxable income subject to a reduced rate of tax equals AX B/C where A equals is taxable income of the banking company. B equals is net markup income earned from such additional advances for the tax year as declared in the annual accounts, and C equals is the total of the net markup and non-markup income of the banking company as per accounts. Relief for approved non-resident banking companies on investment in federal government sovereign debt instrument Rule 8.4. The bill proposes to introduce a new through which approved non-resident banking companies shall be provided exemption from tax on profit on debt or capital gains earned from the federal government's sovereign debt or a sovereign debt instrument. Relief for banking companies on investment in federal government securities Rule 8.5. The Finance Act of 2021 introduced a new subrule, 6A, through which the banking companies were required to pay enhanced tax rates up to 55% on taxable income derived from investment in the federal government securities. Through the SRO 226-1/2023 dated February 27, 2023 applicability of enhanced tax rates on such income was withdrawn for tax year 2024 by inserting Rule 8.5. The bill proposes to incorporate the said relief, as provided under the SRO, by inserting Rule 8.5. The 8th Schedule. NCCPL shall compute and collect super tax Rule 4A. Through Finance Act 2012, rules related to the computation of capital gain on listed securities were introduced in the 8th Schedule to the ordinance, and responsibility to compute and collection of tax was delegated to the NCCPL. Since then, any capital gain or loss arising to persons through the disposal of listed securities which is subject to tax under Section 37A and to which Section 100B apply, shall be computed and determined by provision of 8th Schedule to the ordinance, and tax thereon shall be collected and deposited on behalf of a person by NCCPL. The amount collected by NCCPL on behalf of the taxpayer is to be deposited every year by July 31 next following the financial year in which the amount was collected. Relief for approved non-resident banking companies on investment in federal government sovereign debt instrument. As per existing provisions of the ordinance, super tax liability, if any, arising from capital gain would be discharged by the person at the time of filing of return of income. The bill proposes to extend the scope of NCCPL to include the computation of super tax payable under Section 4C of the ordinance on the amount of capital gain derived from the disposal of listed shares. The taxpayer would however may be required to recompute its super tax liability under Section 4C of the ordinance at the time of filing of return of income after taking into consideration income from all sources in the manner prescribed under Section 4C of the ordinance. After the said proposed amendments, a dispute may arise in case NCCPL computes and collects super tax on those capital gains which are exempted under the ordinance, securities acquired before July 1, 2013, or subject to zero rates, as there are views among tax advisors that no super tax is payable on such securities. Therefore, a clarification should be issued by the Board to resolve any disputes and unnecessary litigations. The 13th Schedule. Section 61 of the ordinance provides for a tax credit to a person in respect of any sum paid or property given by the person as a donation, voluntary contribution, or subscription to non-profit organizations and funds as listed in the 13th Schedule to the ordinance, which was inserted vide Finance Act, 2021. The bill proposes to amend number 64 of the table in the 13th Schedule to give effect to the change of name of Prime Minister's Flood Relief Fund, 2022, to Prime Minister's Relief Fund for Flood, Earthquake and Other Calamities. The bill also proposes to insert the name of Film and Drama Finance Fund at number 65 in the aforementioned table. The 14th Schedule. Rules for computation of profit and gains for small and medium enterprises, SMEs. The Finance Bill proposes to introduce the following amendments to the schedule. Registration. Small and medium enterprises shall be required to register with FBR on its IRIS web portal or Small and Medium Enterprises Development Authority on its SME registration portal, SMERP. Considering the proposed amendment in the definition of SMEs to include persons engaged in IT services or IT-enabled services, the rules now require that such persons shall be registered with and duly certified by the Pakistan Software Export Board, in addition to registration on SMERP. Increase in tax rates. the bill proposes to amend Rule 3 of the schedule to introduce a new category, 3 for SMEs having turnover exceeding 250 million but not exceeding 800 million rupees. SMEs falling under such category and opting for taxation under the normal tax regime, will be subject to tax at 20% of the taxable income. The bill further proposes to amend Rule 4 of the schedule to introduce a new category, 3 for SMEs having turnover exceeding 250 million but not exceeding 800 million rupees. SMEs falling under such category and opting for taxation under final tax regime, will be subject to tax at 0.75% of the gross turnover. Sales Tax Act, 1990. Goods Clause, 12, Section 2. Through Finance Act, 2022, the scope of the term goods, as defined under the above said clause of the Sales Tax Act, 1990, ST Act, was broadened by classifying production, transmission and distribution of electricity within the scope of the said term. It is pertinent to note that recently in 2023, there has been a consensus between the provincial and federal governments regarding rules for the place of provision of services in respect of certain specified services. In light of the said rules, the transmission and distribution of electricity has been treated as a service for which the taxing rights between provinces and the federation would be by the specified rules which shall be effective from July 1, 2023. Consequent to said change, a taxable service entry is also proposed to be inserted through this bill under serial number 60 of Table 1 of the Schedule of Services provided under the ICT Ordinance, 2001 with an applicable tax rate of 15%. Consequently, the bill proposes to restore the previous definition of the term goods before the amendment made by the Finance Act of 2022, by removing the words production, transmission, and distribution of electricity from the definition of goods. Supply Clause, 33, Section 2. The bill proposes to synchronize the definition of supply by removing production, transmission, and distribution of electricity from the definition of supply. The proposed amendment is in line with the amendment proposed for the definition of goods. Tier 1 Retailer Clause, 43A, Section 2. The bill proposes to curtail the current list of qualification criteria for Tier 1 retailers outlined in the ST Act. By this amendment, the retailers of articles of jewelry, precious metal, or metal clad with precious metal, as well as the retailers qualifying based on shop area-based criteria, would be brought out of the scope of Tier 1 retailers provided that they are not covered for the reason of meeting any other qualification criteria specified under Clause 43A, for Tier 1 retailer. Directorate General of Digital Invoicing and Analysis Section 30CA. By substitution of Section 30CA, the bill proposes to change the reference of the Directorate General of Digital Invoicing and Analysis with the Directorate General of Digital Initiatives. Offenses and Penalties Section 33. Presently, any person who manufactures, possesses, transports, distributes, stores, or sells cigarette packs with counterfeited tax stamps, banderoles, stickers, labels, or barcodes or without tax stamps, banderoles, stickers, labels or barcodes is subject to certain penalties under serial number 23 of the table provided under Section 33 of the ST Act, which inter alia includes confiscation of goods and a monetary penalty of 25,000 rupees or 100% of the amount of tax involved, whichever is higher. The bill proposes to expand the scope of such penal action by substituting cigarette packs with goods specified by the board under Section 40C. Fifth Schedule, Zero-Rated Supplies. A. New insertion. The bill proposes to insert the following new entry into the Fifth Schedule to provide a zero-rating facility on imports and supplies made to and by RECO-DIC project. B. Scope of existing entry enhanced. The bill proposes to enhance the scope of zero rating by amending the description of Clause 25, in column 2 of serial number 12 to bring it in line with the description of PCT Code 9017.2000 as explained below. The bill proposes to enhance the scope of zero rating for exporters registered under the Export Facilitation Scheme, 2021, by adding the term commodities to the description in column 2 of serial number 21 as explained below. Sixth Schedule, Exempt Goods. Table I, Imports or Supplies. A. Omission of items currently exempt from sales tax. The bill proposes to omit the following entries from Table I of the Sixth Schedule, which has already become redundant due to the expiration of the exemptions time limit mentioned in their description. B. Limitation on the scope of existing exemptions. Currently, the exemption from sales tax is available to the following goods only in cases where such goods are sold otherwise than in retail packing under a brand name or trademarks. The bill now proposes to withdraw exemption on the following goods sold under a brand name or trademark even sold otherwise than in retail packing. The proposed revisions in the description of such entries are explained below. C. Scope of existing exemptions enhanced. I. In serial number 121 of Table I, the bill proposes to add an explanatory note to clarify that blood transfusion sets not packed in aluminum foil imported with blood bags CPDA 1, in corresponding quantity in the same consignment are also exempt. 2. The bill proposes to increase the time limit of exemption for the following entries from June 30, 2023, to June 30, 2024. Entry number 151, which pertains to supplies and imports of plant, machinery, and equipment for installation in tribal areas. Entry number 152, which pertains to supplies of electricity to residential and commercial consumers in tribal areas. D. New insertion allowing exemption of sales tax. The bill proposes to exempt sales tax on the import or supply of the following items by inserting the respective new entries under Table I of the Sixth Schedule to the ST Act. Table 2, Local Supplies Only. A. Limitation on the scope of existing exemptions. Presently, the exemption from sales tax is not available to the following goods sold in retail packing under the brand name. The bill proposes to withdraw exemption on the following goods sold under a brand name either in retail packing or otherwise. The proposed descriptions of such entries are given below. Eighth Schedule, Goods subject to specified rates. Table I. A. Revision in the reduced sales tax rate. The bill proposes to amend sales tax applicable on the supplies made from retail outlets which are integrated with board's computerized system as under. B. Scope of reduced sales tax rate enhanced. The reduced rate of 1% is presently restricted to substances registered as drugs under the Drugs Act, 1976, and active pharmaceutical ingredients, excluding excipients, for the manufacture of drugs registered under the Drugs Act, 1976, or raw materials for the basic manufacture of pharmaceutical active ingredients. Said reduced rate of 1% is now enhanced to the medicaments classified under Chapter 30 of the First Schedule to the Customs Act, 1969 with certain exceptions. It is important to note that this relief is proposed to be applied retrospectively from July 1, 2022. The tariff headings, Reduced Rate of Sales Tax, and conditions for the application of the reduced rate remain unchanged. The proposed descriptions of entries 81 and 82 are as follows. Federal Excise Act, 2005. Duties specified in the first schedule to be levied Section 3. The bill suggests introducing a new clause, E, to subsection 1, of Section 3 of the Federal Excise Act, 2005, FE Act, expanding the scope of ad valorem, 15%, to cover any item listed in the first schedule to the FE Act. This amendment aims to streamline the application/chargeability of federal excise duty on goods and services. Appointment of federal excise officers and delegation of powers Section 29. To regulate digitalized invoicing, the bill proposes to introduce the Office of the Directorate General of Digital Initiatives, through the insertion of a clause, d, in subsection 2 of Section 29 of the FE Act, which shall consist of a Director General and various other officers appointed by the Board. Power of Board to make rules. Section 40. The bill proposes to introduce a new subsection, 4, into Section 40 of the Act, which requires that all rules made by the Board under the Act shall be collected, arranged, and published along with the general orders and departmental instructions and rulings, if any, and sold to public at reasonable price, or it may be placed on the Board's official website on regular basis. First Schedule. Table I, Excisable Goods. The bill proposes to insert the following new entries to Table I of the First Schedule to the FE Act. Table 2, Excisable Services. Although the term franchise as defined under the FE Act already included technical fees and royalties within its scope, the application of Fed on royalty and technical fees under the head franchise has been a debatable matter subjected to litigations. To overcome this ambiguity, the bill proposes to expressly include the fee for technical services and royalty in the dutiable service heading, by substituting the existing description in entry number 11 of Table 2 in the following manner. Third Schedule. The bill proposes to insert a new entry number 26 to Table I and 15 to Table 2 of the Third Schedule of the FE Act, 2005 to provide an exemption from charging Fed on the entire supply chain of goods and services for RECO-DIC project, presently being considered as a qualified investment in Foreign Investment, Promotion and Protection, Act, 2022. Customs Act, 1969. Smuggle Section 2, S. At present, the definition of smuggle includes the activity of pilferage of transit goods, but its territorial domain was not defined. By amending the above-said definition, the bill proposes to assign municipal limits for customs authorities for conducting anti-smuggling operations in case of pilferage of transit goods as anywhere within the territorial jurisdiction of Pakistan. Customs Academy of Pakistan, CAP, Section 3C. The bill proposes to amend the nomenclature of Section 3C of the Customs Act, 1969 to replace the existing name of Pakistan Customs Academy, PCA, with Customs Academy of Pakistan, CAP, to avoid duplication with the term Post-Clearance Audit, PCA, as already stated under Section 3DD of the Customs Act. Assistance to the Officers of Customs. Section 7. The bill proposes to include provincial levies and Causadar Force and its officers in the list of departments that are bound to assist officers of customs whenever requested. General power to exempt from customs duties. Section 19. At present, the federal government is empowered to exempt custom duties in various specified circumstances and contingencies as mentioned in Section 19(1) of the Act. The bill proposes to extend such powers of the federal government to the event of implementation of an agreement of the Government of Pakistan with any entity. The bill also proposes to extend the protection to all in-field exemption notifications issued on or after the first day of July 2016, up to June 30, 2024. Power to determine the customs value. Section 25A. At present, the Director of Customs Intelligence may incorporate values as benchmarks, from internationally acclaimed publications, periodicals, bulletins, or official websites of manufacturers of indenters, while assigning the values to imported or exported goods. The bill proposes to rephrase the expression with the intent of authorizing the Director of Customs to consult prices of goods available from the above international published sources to ensure that the Director of Customs Intelligence uses such values only as a reference while applying his independent mind in assigning the values to imported or exported goods, rather to merely quote the values from above-mentioned journals. Declaration and assessment for home consumption or warehousing or transshipment. Section 79. At present, the owner of imported goods is required to make entry of such goods for home consumption or warehousing or transshipment or for any other approved purposes, within 10 days of their arrival. The bill proposes to shorten the time limit to 3 days for making such a declaration in respect of goods imported at land customs stations at the border. Warehousing period of the goods. Section 98, 1. The existing subsection, 1, of Section 98 of the Customs Act provides that the perishable goods notified by the Board may remain in the warehouse for a period of 1 month following the date of their admission. The bill proposes to enhance the warehousing period for perishable items up to 3 months to facilitate their trade. Declaration by passenger or crew of baggage. Section 139. Currently, a passenger or member of the crew being the owner of the baggage is required to make a verbal or written declaration of the contents of baggage in a prescribed manner to the appropriate officer. To facilitate passengers traveling as a group, the bill proposes to also allow their representative to file baggage declarations on their behalf. Punishment for offenses. Section 156. Concerning existing penalties as enlisted in Table 1 of Section 156 of the Customs Act, 1969, the bill proposes to introduce amendments in the following manner. A. Penalties relaxed. At present, sub-serial, I, of serial number 1, if any person contravenes the requirement of placement of invoice and packing list inside the import consignment, such person is liable to fine from 50,000 rupees to 500,000 rupees and onward for every recurring violation. Considering the grievances of the trade, the bill seeks to omit this penalty. 2. Currently sub-serial, 3, of serial number 1 of Section 156 of the Customs Act provides a penalty from 50,000 rupees to 250,000 rupees and onwards for every recurring contravention of electronically uploading mandatory documents as required under Section 79 or 131 of the Customs Act, 1969. The bill proposed to restrict the penalty under this offense to a maximum amount of 50,000 rupees. B. Penalties enhanced. At present, no lower limit had been prescribed in the below-mentioned clauses for imposition of a penalty. The bill now seeks to set lower limits to make penal provisions more stringent, whereby penalty cannot be charged at a value less than the value of the goods. Smuggling of goods into or outside Pakistan is liable to penalty under Clause B, C, D, and E, of sub-serial, I, of serial number 8 up to an amount not exceeding 2, 3, 4, and 5 times of the value of goods respectively, depending upon the value of such goods. 2. About the goods imported or exported in contravention of the restrictions imposed as per serial number 9, the maximum penalty may be of an amount not exceeding 2 times the value of the goods. A. Any person acquires possession of or is in any way concerned in carrying, removing, depositing, harboring, keeping or concealing, retailing, or in any manner dealing with smuggled goods or any goods in respect to which there may be reasonable suspicion that they are smuggled goods, the maximum amount of penalty is 10 times of the value of goods as per sub-serial, I, of serial number 89. B. Any person involved in evasion of duty/taxes and breach of prohibitions or restrictions, as laid down in serial number 90, is liable to a penalty not exceeding 10 times the value of the goods. Power of adjudication. Section 179. Currently, subsection 2 of Section 179 provides powers to the Board to fix, vary, or transfer the jurisdiction of any officer of customs and assign any case irrespective of the territorial jurisdiction. To reduce the clearance time and eliminate human interaction, the bill seeks to provide an option to the importer/exporter of the goods to opt for adjudication through the customs computerized system. Vesting of confiscated property in the federal government. Section 182. At present, federal government is empowered to authorize the use of confiscated vehicles for operational purposes by the Board or, to its subordinated officers. The bill proposes to enhance the scope of such confiscated properties by including therein confiscated conveyance or any other equipment. Transfer of cases. Section 185d. The bill proposes to facilitate ongoing investigation of criminal cases through transfer thereof from one field formation to another, as per need regardless of their stage of investigation. Appeals to the Appellate Tribunal. Section 194a. At present, certain orders are prescribed under Section 194A of the Customs Act against which an appeal before the appellate tribunal can be filed. The bill proposes to add one more classification of order, being an appellate order or a quasi-judicial order passed by the Chief Collector of Customs against which an appeal before the appellate tribunal can be filed, however, subject to the condition that such appeal shall be heard by a special bench consisting of one technical member and one judicial member. As per notes to the clauses published by the federal government, said provision is being introduced to keep the respective provisions of the Customs Act streamlined with Chapter 10 of the revised Kyoto Convention of the World Customs Organization. Person to produce authority if required. Section 208. At present, customs agents holding customs licenses are mainly allowed to transact business on behalf of importers, including filing of goods declarations, GDs, while importers are also allowed to do so by themselves. The bill proposes to introduce a proviso in the above section that the Federal Board of Revenue may issue rules in respect of the eligibility of a person for self-filing of GDs by importers in line with the provisions of registered user specified in Section 155C of the Customs Act. Advance Ruling. Section 212B. At present, advance ruling can be sought in respect of the following questions of law. I. Classification of goods under the first schedule to this Act. 2. Determination of the origin of the goods under the rules of origin notified for bilateral and multilateral agreements. 3. Applicability of notifications issued in respect of duties under this Act or any tax or duty chargeable under any of the law for the time being in force in the same manner as duty of customs leviable under Customs Act, or for any other matter as the Board may specify by notification in the Official Gazette. The bill proposes to close the door for obtaining an advance ruling in respect of the applicability of notifications mentioned in 3, above through omission of the same, on the premise that interpretation of any statute concerning liability in respect of ongoing transactions which otherwise lies in the domain of FBR, falls outside the purview of advance ruling. Islamabad Capital Territory, Tax on Services, Ordinance. Scope of Tax. Section 3. Subsection 2A of Section 3 of the Islamabad Capital Territory, Tax on Services, Ordinance, 2001 specifies certain provisions of the Sales Tax Act, 1990, St. Act, which shall mutatis mutandis apply to the services rendered or provided under the said ordinance. The bill proposes to enhance the scope of the said subsection with the following effect. Freelance exporters of IT and IT-enabled services would not be required to obtain registration subject to capping of annual turnover of 8 million rupees. By substitution of Clause A, the limit of freelance exporters exclusively engaged in the export of IT and IT-enabled services has been proposed to be treated as a cottage industry as defined under Section 2(5)(ab) of the St. Act, for which no requirement for registration and filing of return exists under the St. law. This immunity from sales tax registration requirement to the freelance exporters of IT and IT-enabled services would be subject to meeting the condition of maximum annual turnover specified for a cottage industry of 8 million rupees under Clause D of Section 2(5)(ab) of the St. Act. The above intention of the law to provide immunity from registration requirements needs to be streamlined by making corresponding amendments in Section 14(1)(a) of the St. Act or otherwise, as the said clause of Section 14(1) excludes cottage industries as manufacturers only. Besides, for the above said proposition, the bill explains a freelance exporter as a person who works on per job and on a self-employed basis without being attached to or under the employment of any other person, having the liberty to work on various tasks simultaneously. 2. Zero rating facility to services provided for RECO-DIC project. Through expanding the scope of existing Clause B of subsection 2A of Section 3 regarding zero rating entries in the Fifth Schedule to the St. Act, the bill proposes to extend the zero rating facility to taxable services provided about the RECO-DIC project, presently being considered as a qualified investment in Foreign Investment, Promotion and Protection, Act, 2022, for which imports and supplies have also been proposed to be zero-rated through the insertion of entry number 8A in the 5th Schedule to the ST Act. A. Services taxable at standard rate. Table 1I, description substituted. The bill proposes to substitute the existing description of services specified in serial number 1 of Table 1 with a new description. By this amendment, services of restaurants including cafes, and similar cooked, prepared, or ready-to-eat food service outlets are now chargeable to sales tax at the rate of 5% if payment is received through debit or credit cards, mobile wallets, or QR scanning. The proposed substitution is explained as follows. 2. Reduction in standard rate. The bill proposes to reduce the standard rate of sales tax to 15% for services specified in Table 1 under. 3. New insertion. The bill proposes to insert the following service to be chargeable to sales tax under ICT Ordinance. B. Services taxable at reduced rate, Table 2. Rate of tax 15% through Finance Act, 2022, the entry of IT services and IT-enabled services specified under S.No.11 of Table 2 to the ICT Ordinance was substituted with the description of services provided by software or IT-based system development consultants, which was taxable at 5% with no restriction on input tax adjustment. The bill proposes to restore the previous position before such substitution by replacing the existing entry as follows. These were the changes and amendments made in the whole taxation system of Pakistan in the Budget 2023-24. If you like my video, please hit the like button and subscribe to my channel so that you could get my upcoming videos.